Japan's ruling LDP party loses a key election, but Prime Minister Shigeru Ishiba vows not to resign while he's still negotiating tariffs with Donald Trump. So the yen rose 1%, and New Zealand's inflation is softer than forecasts. That's coming up in 5 Things in 5 Minutes on Tuesday, July the 22nd. And then in part 2 of our deep dive interview with ANZ senior rate strategist Jack Chambers, he looks beyond America's fiscal issues to the UK and Australia.
You could argue the UK was a bit of the canary in the coal mine. Now, the UK back in September of 2022 had their Liz Truss moment.
But first, in 5 and 5 with ANZ, Japan's ruling Liberal Democratic Party lost its majority in Japan's upper house yesterday. It lost its majority in the lower house last year. ANZ senior international economist Tom Kenny explains the significance.
This is the first time since the inception of the LDP in 1955 that it has failed to secure a majority in either the lower house and or the upper house. Since October last year, the ruling LDP Komeito coalition have run as a minority government. This means it has had to do deals on a policy-by-policy basis with opposition parties to get legislation passed. The government will be even under greater pressure now to get deals done with opposition parties, as legislation also requires the support of the upper house.
As of 4 a.m. Sydney Melbourne time, the S&P 500 was up 0.5% to another record high on strong tech earnings, while the US 10-year Treasury yield fell another 7 basis points to 4.35% on safe haven demand as fears about tariff turmoil are growing. That's helped gold too. It rose 1.5% to $3,408 an ounce, while West Texas Intermediate oil futures fell 0.2% to $65.89 a barrel. The US dollar index was down 0.6%, and it was all about the US dollar falling 1% against the yen. More on that in a minute. The Aussie dollar was up 0.3% at 65.27 US cents, and the Kiwi was up 0.3% at 59.77 US cents. Number 2. Tom says the comments yesterday from Prime Minister Shigeru Ishiba that he won't resign are also important.
One of the reasons Ishiba wants to remain as PM is because his administration has been in several rounds of negotiations with the US administration to get a trade deal done before the 1st of August, deadline sought by President Trump. If an agreement cannot be reached by then, Japanese importers could face a tariff rate of 25%. A change in leadership in Japan would almost certainly result in a failure to meet that 1st of August deadline.
Number 3. Japan's opposition parties have been keen to cut its consumption tax, which was worrying financial markets concerned about Japan's fiscal deficit and borrowing. Here's Tom again.
So far, the government has been reluctant to consider such a policy move, given the overall fiscal position is precarious in Japan. Recent developments on both the political and trade fronts have raised already elevated uncertainty. The Bank of Japan has taken a cautious approach to monetary policy in this environment, preferring to see how tariffs impact the economy before taking any decisions. Lingering elevated uncertainty means our view of a 25 basis point rate hike from the Bank of Japan at its October monetary policy meeting is at risk of being delayed to next year.
Number 4. The Prime Minister's decision not to resign was good news for those in currency markets who went into the weekend elections fearing a resignation. That saw the yen rise around 1%. It's at 147 yen to the US dollar at 4 a.m. Sydney Melbourne time. Here's ANZ FX strategist Felix Ryan to explain.
If he had resigned, then maybe there would have been some more uncertainty around Japan's outlook, particularly around maybe Japan's approach to US trade policy as well. So given that he seems to be staying on, there seems to be some more, or a perception of more continuity there, which maybe at the margins probably just help the yen a bit more than more uncertain situations would.
Number 5. New Zealand's annual CPI inflation rate rose in the June quarter to 2.7% from 2.5%, thanks to higher food and electricity prices and a jump in council rates. But it was slightly lower than market expectations. Here's ANZ New Zealand Chief Economist Sharon Zollner to explain the result.
It's not a slam dunk that this release didn't scream, hey, all good, inflation's solved, and the Reserve Bank does need to be cautious. And you could point to some things like those core measures. Also, services inflation was pretty chunky. But overall, I think we can characterise this as consistent with the RBNZ's expectation and therefore not challenging the strong guidance that they gave at their review of the monetary policy statement this month, that they do expect to cut the OCR next month.
Sharon Zollner there. Now, in part 2 of our deep dive interview with ANZ senior rate strategist Jack Chambers, he looks beyond America's fiscal issues to the UK, Australia and New Zealand. In part 1, he looked at how rising US long bond yields was lifting yields globally. My colleague, Alex Tarrant, then asked if the UK government and others, such as Australia and New Zealand, were also facing questions about their debt and borrowing.
You could argue the UK was a bit of the canary in the coal mine. Now, the UK back in September of 2022 had their Liz Truss moment, or under the Liz Truss government, where they had the budget and you had some significant sort of distortions in the gilts market. But what it kind of told us was markets were more sensitive about a developed market sovereign government increasing its debt supply significantly. That was sort of the first red flag we had of this return of term premiums. And whilst we're not seeing the sort of dramatic moves as we saw in the UK back then, we're still seeing these sort of general moves higher in rates. In terms of other markets, I mean, in some ways, Australia and New Zealand are sort of passengers in this story, just in the sense that if 30-year Treasury yields, JGB yields, bond yields all move higher, that essentially just forces 30-year ACGB and NZGB yields higher in kind of concert with it, just because the investors in these assets are comparing across countries, comparing across markets and saying, where can they get the best return or risk-adjusted return? So there's a kind of a rising tide lifts all boats sort of effect. We actually have seen, by some metrics, 30-year ACGBs, so Australian Commonwealth government bonds, have actually outperformed a little bit. Their yields have risen a little bit less. Their prices have fallen a little bit less. The reason for that is just because there's expectations of limited supply in that particular part of the curve. It's not because there's not a lot of debt issuance. If anything, the Australian government is planning on its largest ever increase in the free float of bonds this financial year. The amount of bonds the market has to absorb on a net basis, once accounting for maturity. So we almost have, once you have the core, let's say the core countries, Japan, the US and Germany, their long-end bond yields rising, that ends up becoming a unifying move across most G10 countries, across most developed markets. The one country that is the big outlier, or a particularly large outlier, is China. 30-year Chinese government bond yields have not really risen all that much this year. They've been with the one exception, they've been relatively range-bound and they haven't exhibited much trend. The reason for that is ultimately it comes down to the different sort of medium to long-term economic fortunes in China. In China, if anything, they're concerned about medium-term deflationary or disinflationary pressures. A lot of Chinese growth we expect over the medium term will come from government-related investment. It's still relying and waiting on that switch to consumption or household consumption-related spending to drive the economy. That sort of dynamic is keeping, I guess, long-end Chinese government bond yields much more range-bound and much more capped than we're seeing in a lot of other countries.
Back to Australia and New Zealand, it's quite interesting there. So we're seeing that yields rise, maybe not as much, but still rise. It's not so much a story of like the policy uncertainty that we're seeing in the US and other parts of the world. Is that right?
Exactly. So one way of thinking about 30-year bond yields in Australia is there aren't actually a lot of natural investors domestically in those. Who are the primary buyers of a 30-year bond? It's mostly people, or mostly institutional investors, that are matching long-term assets. They have a natural desire to buy a long-term bond to offset sort of their 30-year or their long-term liability. So I'm thinking defined benefit pensions, insurers, that type of investor. With Australia, given the prevalence of superannuation funds, which are for the most part defined contribution, they don't have that need to buy a 30-year asset. So what you see is the ultra-long part of the ACGB curve, so the 30-year sort of part of the ACGB curve, tends to be dominated by offshore investors. Given that dominance of the offshore investors, they are looking at ACGBs, particularly at the 30-year part of the curve, on a cross-market basis relative to treasuries, Canadian government bonds, JGB, Japanese government bonds. So the increase in policy uncertainty globally just manifests and flows through to what's happening in AUD yields, even if there isn't particular policy or an increase in policy uncertainty specific to Australia.
Jack Chambers there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Tuesday, July the 22nd. Catch you tomorrow with detail from the Reserve Bank of Australia's board minutes from its last meeting, which are due later today. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.